All right, we're getting started here. Hey, everyone, it's Mitch Goldberg. We're just getting started. You're watching my live stream. Be the boss of your money. It's about personal finance, investing. We talk an awful lot about our favorite subject here, the stock market. Not just because we're looking, no, we're not necessarily because we want to trade. Actually, I talk about how I don't want to trade. This whole show is about long term investing. And maybe I'm a little sensitive, but I put up a LinkedIn post today and I got the weirdest response. And I'm just going to say that my internet signal is not that strong right now, but hopefully we'll be able to continue on. I just want to say that this is going to be very controversial. Do you like to hear controversial things? That's what's good about like live streaming on social media. You could say controversial stuff and like it's okay. Even more so than cable TV. Cable TV has become like, mainstream, right? But let me say, I can tell what I can tell which generation an investor comes from. Whether somebody is young, let's say millennial, Gen Z, Gen X, or boomer. I can tell based on how they invest, based on their expectations. Yeah, I really could. Uh, and I find that boomers are much more likely, in my own estimation, because I've been in the business for 32 years, and the way that I did business with boomers when they were, middle age and younger, they're still in that mode. It's like they still think, oh, you have a $17 stock, it goes to 25. Oh, you got to take that, take it and run. Or they still think that maybe you should try to get out of the market in bear markets and get back in for a bull market. I really believe that. And this isn't for everyone. I'm just saying, but I got a very weird response on a LinkedIn post today. And I looked the person up, but I'm like, you sound like what I was. This guy sounded like my sales pitch from 1990. I'll get you out of the market. I'll get you in the market. Basically saying that buying and holding is foolish. Not There was nothing about individual stocks or index funds or just mutual funds in general in this post. The guy just said you should just if your research says you should sell something, you don't sell it and you hold on to it, you stick with it. You're violating a fiduciary responsibility. I never said I don't trade or sell or get out of something, sell a stock out of a client's account or my own account if I think it needs to be sold. But today's investors, I'm talking like my Gen X and millennial and Gen Zers, okay? We are more about making our investment choices based on our personal finance. You know, we're the generations that say, excuse me, we're the generation that asks, well, how many years until you need the money? What are your monthly expenses for the next 6 to 12 months? What big expenses do you have coming up? Uh, are you being tax efficient? Have you updated your will? Have you updated the beneficiary designations on your retirement accounts? When was the last time you raised the amount of money that you contribute to your 401k plan? Right? Holding somebody off because they want to sell because they're worried about the market. If you're in index funds and you have a plan and a strategy, an investing strategy, an investment portfolio, it should already take into account that we're going to have up and down markets. Now, now I want to go into it if you're an individual stock investor. By the way, with an index, a stock index like the S&P 500, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. For individual stockholders, it could be perilous because you could get stuck in a stock. I have some stocks now that I am just upset with, but I have some stocks I'm very happy with. But that's diversification. Some zig, some zag. The idea is that ultimately your investments should work over time. You don't know when that's going to be, and they work out at different times along the way. But over the long term, you expect all of them to work out. All right. They just do it at different times, which makes your zigs and zags, your volatility in your overall portfolio a little smoother, which for some people is important. It helps them stick with their investments. And if something doesn't work out, that's okay because you have lots of other investments to pull the weight of the portfolio. Okay. That's where we diversify. And that's a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market like the one we've been in for the last few months. Okay. So I could see like when I'm talking to someone who's like 35, 30, I'm not including those who are just like trading on a Robinhood account or something. I'm generally speaking like somebody who's 30, 35, 40, or my age, I'm 54. We're investing in a retirement plan. We're diversified. We're investing monthly. It's an asset allocation model based on cash, stocks, and bonds. We hold on to that through thick and thin. I don't try to get out of all my exchange traded funds or mutual funds, what have you, because the market's down and I want to beat the market by doing that and I'll get back in at a better time. I'm the one who tells you how foolish it is to try to do that because you procrastinate. Because if you get out and the market goes down, you never get back in. Because if the market does go back up, you'll say, I could have had it lower. Now I'm going to wait for it to go back down. And if it goes back down, you'll say, well, now it's going lower, so I'm going to wait for it to go even lower. And then it goes lower, and you say, you see, I'm right. I'm validated. It validated my decision, so I'm going to wait for it to go even lower. Then it goes up, and you say to yourself, I could have had it when it was lower. And it's just a cycle of back and forth, and it becomes long-term procrastination when we know time in the market is greater than timing the market. I hope that makes sense to you. Let's roll a quick introduction while you're watching. If you have any questions, of course, while you're watching, right? But even after you watch, if you have any questions, hit me up in the comments. If you want to ask me a question while we're doing the show, that's even more fun. I love to read your comments aloud and respond to you while we're actually doing the show live. Give us a thumbs up, a heart, a celebrate reaction like on LinkedIn. Whatever platform you're watching on, give me some reaction. Let me know you're out there, and I'll see your name. And the introduction is going to be rolled right now. This is going to be a really good show. We're going to talk about Robinhood and Coinbase. All right, welcome back. I'm Mitch Goldberg. We're just getting started. It's 4:50 p.m. Usually we get started at 4:30. There are just some days when the day is just, out of control, and it's like a lot of days like that. I do my best to keep it in control, but I do have to I have to take care of things. I do have clients, I do have a business. My job is actually not to live stream, but it is part of my job to market, grow my business, to bring on new accounts, right, new clients. And I love doing it with the live stream and the content I create. I'm just enjoying it. Okay. We already have our first person out there, and we have, hey, Mitchell, I hope you are well. Thank you very much, Nick. By the way, Nick Nielsen, go follow him. He's one of the few people whose bell I rang. That might sound weird, but let me explain. I rang Nick's bell on LinkedIn because LinkedIn has a follow feature. You could just ring on, hit somebody's bell, like a bell notification, almost like YouTube, and you could follow that person. So whenever they have a new post, you'll get a notification immediately. So thank you very much, Nick. Nick makes, I think, the best educational content there is in the entire financial services industry. So you should follow Nick. I'll just show you that LinkedIn post. Do you mind if I show you that LinkedIn post? I know. It's not that like I'm so bothered by it, but I'm just like, when somebody does something so stupid, it's like, all right, here, let me share my screen. Okay, I'll make this a little bigger. Right now, you're on my LinkedIn. I have a couple of screens going at once. You only see, it might look to you like I'm only on one, but I'm on a couple of screens right now. Let me get rid of that. All right, this is the picture I posted. All right, I don't know if you know this about me, but I make these cardboard pictures, and I take pictures, wherever I am. It's very easy to do. I just happen to have a piece of cardboard with me, right? Market bottoms are a process, not an event. This is not a fake backdrop. I was in New York City. I was standing on the street right there. I was with my daughter. We were heading to the New York Auto Show, the International New York Auto Show at the Jacob Javits Center, and it was a safe place to stand. There were no cars or bikes coming through. So that was the money shot. Market bottoms are a process, not an event. And the comment I refer to, I don't know if it's going to pop up here. Oh boy, this guy did it again. Okay. He says guys, comment on this if you're while you're watching this. Comment on this. What do you think? He says, Mitchell, the only reason to buy or hold any stock is because you believe the price will appreciate. If your research does not say the price will appreciate, I'm not even allowed to use the word will appreciate because it's a securities issue. But this person who says he's a securities and real estate attorney will use the word will appreciate. You are violating your fiduciary duty. It's not very often that somebody even talks to me about violating fiduciary duty to your clients. Stay the course, and a down market is foolish advice. It's foolish advice, guys. So I wrote, I completely disagree. Staying the course doesn't mean nor imply that one is not permitted to trade or sell, of which I said neither. Wondering if you read the post or just going by my pick. Didn't say whether or not I was speaking funds for exposure to an asset class or individual stocks. Regardless, long-term investing and sticking to a plan based on one's personal finance, as described in the post, is something I am sticking with. How that violates my fiduciary responsibility is a mystery to me. Sincerely, Foolish in New York. And this gentleman wrote, you have to be willing to accept a lot of risk to stay in this market, far more risk than most investors want. Well, how does he know what most investors want? I think it's more based on your age. If you're 75, well, you should probably have less risk exposure, cash on the sideline to pay for your expenses, and a little bit of money in the market. So if you do live till 95, you still have some way to beat inflation with some of your money, right? Anyway, the U.S. and global economies have slowed by a 2-year pandemic. We know that, which is far from over. Okay, this is a long, you know what? I have to give this guy kudos because this gentleman, he did take the time to write me back. And I'm going to thank him for that because anyone who takes their time to write to me in a post is pretty cool. So maybe I'll just thank him. I'll read the rest of this later. Okay, there's also generation shift. We'll see. But I appreciate you, Erwin, and thank you very much. And I'll reply a little later. I'm kind of doing the show right now. So I got more notifications. Yeah, that's the one from Erwin. All right, I'm going to have to friend Erwin. Let's go to Erwin's page. Erwin, I don't see your sign, your picture. I'm sure you're a handsome dude. So let's we have 58 mutual connections. It's a lot. And you're in California? How do we have so many connections if you're in California? Let's connect. What the hell? All right. I'm just going to send the connection invitation. If you don't know how LinkedIn works, this is how it works. Okay. So let me get out of that and let's get to the heart of the matter. I want to talk to you about what this rally from the pandemic meant and what it is now. We've talked about this so many times, but there's a different angle here. There's a different angle. Well, I'm not chiding you. I'm just saying I'm just saying we talk about this all the time, all right? And I'm not trying to be like, we talked about this already. I'm not trying to be like that. Calm down, okay. But I think the two stocks, there's a few stocks that really became emblematic of the pandemic rally from end of March of 2020 to the peak of in 2021. Okay. I know the major averages hit a peak early in 2022, but that was based on very few stocks with poor breath. But most stocks had already been going down since the middle of last year. So for about a year, most stocks have been going down, even longer than that. DoorDash, Zoom, Peloton, these stocks, Peloton, the CEO actually came out today after the earnings came out and said he said he didn't realize like how bad things really were at Peloton when he got the job. Like Peloton has so much stuff stored in warehouses, they can't even sell it. There's just not enough demand for their products. Um, I don't know when somebody is going to question whether or not that company could be a going concern. But SoFi stock is a $5 stock now. It's basically it's just about to the point where it's considered a penny stock. They also put their name on a stadium where the Super Bowl was played. It's like the curse of companies that put their names on stadiums. By the way, I knew that when they announced it. That SoFi, I already there's already articles written about it that companies that put their name on a stadium, it's usually like their peak, and it's all downhill from there. SoFi is no exception, and a lot of these disruptors, the DeFi, decentralized financial companies, they were supposed to be the disruptors, and these stocks are just all getting crushed. Even PayPal has gotten absolutely annihilated. The stock just absolutely destroyed. There was another one today. I forget the name of it. Uh, there was another. Filippo, you're watching this. What was the other DeFi stock? It went down like 55% today. I could look it up, but I just have too many screens going on right now. I've got a couple buddies out there. Just have to say a few hellos. Rhonda, thank you so much for joining us. Appreciate it. I'm hoping that we meet at an upcoming FPA event, so we can finally say hello in person. Big hug, Phil is Phil, my man. Phil has 15 guitars, and I want Phil to do an expose or something on his guitars. Phil is my my musical inspiration. And Nick, okay, so Nick, maybe as a securities attorney, we're getting back to those comments before on LinkedIn. Nick says maybe as a securities attorney, he can let us know the best time to sell and the best time to buy. That would be a great help. That is a beautiful, beautiful response. And that's why I said before, you are the best person to follow on LinkedIn. You put out the most educational, highest quality content there is because you think of these things. I wish I thought of saying that. If you don't put that in the comment, by the way, I will. So make sure you say that in the comment on the LinkedIn post, okay? Rhonda, I'll take one. Okay. Filippo, crypto.com, same thing with the stadium. Lunaterra, is that? Lunaterra is, and UST, those are the stable coins that broke the buck today. It's UST broke the buck. Its sister coin, I guess, is Lunaterra. And apparently UST, unlike other stable coins, which is supposed to have a certain amount of money in very short-term securities and dollars, they put their money into Bitcoin. So now that Bitcoin is headed south, they broke the dollar. And that's not really, it's not really supposed to happen. And I think that's one of the reasons why the SEC needs to get the hell in here and regulate this stuff. And by the way, most crypto investors I know actually would welcome some regulation. They think it would be better for the market and they would make more money. So there's a case for regulation here. Okay, it's still the Wild West, and a lot of people get involved with crypto who they don't really understand it. They get involved with it because they heard it's going up, or they got a tip from somebody, or there's a new one out, and they just hear it's going to go up, go crazy, and that's the one they buy. That's the extent of their due diligence. Filippo says not enough liquidity. That's right. Always the issue is liquidity. They should create a liquidity metric to master crypto and stocks. I think that's a really good idea. I mean, they I don't know about crypto, but I know with stocks that you could always look up the volume to see if the volume is surging or going down. But I'm not sure if that works with crypto. I don't trade crypto, and I'm not on any I'm not on Coinbase or any of the crypto exchanges. I don't know if like the volume is shown, but you could track the volume and see liquidity. I guess. I mean, but I hear what you're saying. Maybe there should be like just an easy to use metric which tells you if the volume is decreasing or increasing. Maybe it would be easier. The technology is there. So I hear what you're saying. Okay, so we're talking about the key pandemic stocks. We're talking Zoom, DoorDash. There's a whole bunch of them, but I think those are like the premier names of the pandemic. But the purveyors. Okay, this is the key. The purveyors. I love to say that, purveyor. We are a purveyor of fine beer and spirits. The purveyor. I'm kind of hungry. Okay, the purveyor is Coinbase and Robinhood, the purveyors of the new economy, of the level playing field of the market, of the crypto stuff, right? So let's take a look. First of all, Robinhood, which actually became its own version of a meme stock not too long ago, um, hit a 52-week. Oh, Robinhood, okay, hit a 52-week low today. It went to a low of 891. It rose a little bit off its low to 927, giving back 8 cents in aftermarket trading at 919, down from 85. I think it came public at 40, and then it shot to 85, and people are like, oh, we got to own it. You need to own this. We need to be in Robinhood. Whatever your reason was, it's the purveyor of the new stock economy, the new wealth economy. I've put out a lot of content about Robinhood, and no knock against Robin hoodies. And what I admired about this company early on was, before they went public, was how they created a community. It's like Robinhood. When you were trading in Robinhood early in the pandemic, it wasn't just about Robinhood. You felt like you were part of this special community, and seemed really cool, really fun. But then what came out is it was all just about getting trades in for payment for order flow. And then my thought process turned to, if you have an account with Robinhood, my feeling is you are in an abusive relationship, and it's not good for the industry. It's bad for all of us in the industry. It's bad for the public. It's bad for the industry. Anyway, from $85 to $9, it's like an $8.50 stock going to 92 cents. It's absolute crushing blow. They announced layoffs recently. Volumes are down. There's really nothing good to celebrate about it. And then the other one is Coinbase. Now, this was one of the most sought after IPOs. They're known as the premium numero uno player in the world of crypto. You want to trade crypto, you want to buy, you want to sell, open up an account, which is basically a digital wallet. You've got Coinbase, 368 to 64. It's like a $36 stock going to $64. See this? You see this right here? It's down $8.50. This is aftermarket trading. Their numbers missed. They just came out with their quarterly numbers. Missed. Things aren't so great. The future isn't as good as we thought. Stock is down over 11% in the aftermarket trading to 64 from 368. It did hold up in the 200s for a while. Then it seemed like 180 was the price. I really did consider buying the stock, and I just never did. I just every time I get close to the flame, I feel the heat a little too much. I as much as I talk about crypto, I still don't fully grasp what makes it so attractive. It's a piece of software. It's on a blockchain. I get that. It's almost impossible to duplicate. It is impossible to duplicate. You could track it. You could trade it. There's a certain amount of anonymity to it, which is not as anonymous as people thought, because the U.S. authorities recently caught some criminals who stole Bitcoin. They were able to track them down using the blockchain. So that's pretty cool. Anyway, Coinbase and Robinhood, basically the way these stocks have done, if these don't signal the end of the pandemic rally, the stock market pandemic rally, then I don't know what does. And lastly, Amazon has completely given up its pandemic rally. Isn't that amazing? And Amazon is doing better than ever. It just goes to show you. So it's, the doing business, or people say, hey, but the earnings were good, but this is good. Doesn't matter. Other things count too, like interest rates, like long-term rates hitting 3%, like the Fed pledging to raise rates to squash inflation, to slow growth in the United States economy, right? All about inflation, rising rates. These count also. And then investor psychology changes. Oh my, investor psychology is like, it's mega important. People's psychology changes. Instead of buying dips and selling rallies, or just buying dips and holding, they start to say, I just want to preserve whatever money I have left and just get me out at any price. Liquidity is low. So uh, market makers, when liquidity is low, market makers, specialists, they could back away from bids. They don't have to commit to as much capital or commit to buying as much stock as they would have when there was more liquidity. So they back away. And then you see them just drop bids from like 800 down $50. Just bids just get crushed immediately. And that's what happens. Fed's taking liquidity out of the market, right? Um, and when you get to this kind of volatility, banks don't want to trade, hedge funds don't want to trade, and they walk out of the casino. They don't want to play. They don't want to play anymore. They just take their ball and go home. So it reduces liquidity. It's a very, very difficult market to be in. It's certainly very difficult to make any calls. The fact is, most of us are long-term investors, and we're not going to really change anything. But if you have this knowledge, maybe it'll prevent you from getting frightened and doing something that you shouldn't be doing with your money. Okay. Filippo, always the issue is liquidity. They should create liquidity match. Yeah, we definitely agree on that. The only thing that makes crypto attractive is for countries that have issues, war, inflation. I have exposure, but it's highly, highly risky, and most people probably shouldn't mess with crypto. Well, Filippo, oddly enough, when I wanted to do one of these live streams about crypto, I had you on as my guest because you are my go-to guy for crypto. You. So I definitely appreciate that. If you're telling me that, that's what I'm going by. All right. Let's take a look at the big board today. Okay. All right. So the Dow was down a measly 85 points. Uh, Another down day, but in my book, down 85 points, it's a good day. The Dow surged 500 points right after the open, thinking, oh, we're going to have a rebound here. Then it went down 350 points. You had an 850 point swing from peak to trough, and it finished down 85 points on the Dow. Now, why would the Dow be down, but the Nasdaq and the S&P be up? I'm going to show you. I'll show you why. Okay, you see this? IBM was down, JP Morgan, 3M, Home Depot, Caterpillar, okay, Nike, Walmart, Goldman Sachs, Walgreens, Dow, Verizon. Just those are the ones that are down over $1. We had a lot of, Dow stocks. The Dow is not the same as the S&P. The Dow is only 30 stocks. It's a price-weighted index. So a higher price stock, as opposed to a bigger market cap stock, has a bigger weighting in the index. Just so you know that all it took was, a handful of Dow stocks to be down more than $1 to push the Dow slightly into negative territory. And I say slightly because being down 85 points on the Dow is not a big deal. Okay. What worked today in the Dow? Okay. Intel, Salesforce, Microsoft, Apple, and Cisco. So oddly enough, the technology components in the Dow are what work. And I know that these stocks are all in the S&P 500, but it's just to a different exposure amount. Okay. For example, Amgen, which is $240, has a bigger impact on the Dow than Apple, which is only $154, because you're going by the price. 240 is bigger than 154. But if you're looking at the S&P 500, well, Apple has a much bigger impact because it's like a $2 trillion plus company. And Amgen is, I don't know, I mean, it's probably in the hundreds of billions, but still a lot smaller than Apple. Okay. Let's get back to the board. That's not what I wanted. That's what I wanted. Okay. So NASDAQ had barely a bounce, up less than 1%. S&P barely a bounce, up 0.25%. Gold just does not hold a bid. If you're really worried about inflation, it's been about 1800 to 1900 forever. If it touched 2000 for a very short, just a brief amount of time, but it didn't hold it. So I'm not really That is a weird thing if for and we do have inflation, but maybe gold is telling you that yeah, the inflation may have peaked. Tomorrow, okay, Wednesday the 11th, we have big inflation numbers coming out. All right, the CPI, the almighty CPI, and we're expecting it to be a little bit lower than the 8.5% print last month. And investors want to see that because they want to believe, or they believe that it could show that inflation for now has peaked. Who knows if it's peaked? I think we're going to have to give it a couple of months of CPI reports to really see if inflation has, in fact, peaked. Not to say it can't surge again after that, but at least for now. Okay. VIX wound up going down to 32.99. All right. VIX is a fear gauge. If we see that hit 20 or below, markets are back to bull market, baby. Stays above 30, stays above 25, continues to be a choppy, ugly, frightened, rocky market. Excuse me. Let's take a look at bonds. 3-year was up to 3%. Look, 3% to 2.8 is a lot for the 3-year, and the 10-year 2.98. Okay, so little bit of I think flight to safety trade, people shifting money into bonds after yields have gone up, and now investors may perceive bonds as a decent value, especially when they're afraid of stocks. Crypto, Bitcoin has been getting absolutely hammered, but I can't believe it. Bitcoin is 30,900, so under 31. This stock, it was just like 41,000 stock. This Bitcoin was just 41, 42,000, down to 30. And it basically follows the NASDAQ. So it's got a high beta, meaning if the NASDAQ is up or down 5%, you'll probably see Bitcoin go up or down 30%. I don't know if that's the exact ratio, but that's what I mean by it's got a high beta. I guess it's the international language for whatever, for high beta. You got high beta for compared to the NASDAQ. Okay. I heard someone say the NASDAQ is basically a sector fund because it's all technology and communications, or 80%. I totally agree with that. But when I heard that, I was like, duh. But this guy gets credit for saying it on TV when we all know it. I mean, what's the deal with that, man? And let's tell you why the market was able to hold up. Remember we spoke about this yesterday, the FANG M stocks, these are the biggest companies. Apple up, Amazon, Meta, which is Facebook, Google, which is now called Alphabet, Microsoft, NVIDIA. When these stocks go up, they're going to bring the market go up. It's very difficult to have a sustained rally in the S&P 500 or the NASDAQ without these companies participating. Okay. How are we doing for time? I think we're good. I think that's it. So that's the show. Thank you so much for joining me. Hope you enjoyed it. If you think of anything you want to ask me or say, or words of wisdom or encouragement after, thank you. If you're watching this in replay, thank you for joining me. Hit me up in the comments. I'll definitely see those and get back to you. And until next time.